Buddy, this is it. It's another Monday. What are we going to talk about? We're going to talk about growth, and we're going to talk about today. We're going to go the other side of growth. So most of the time when I do this live stream, you get it from the perspective. For those of you who haven't joined us before, most of you have, but for those of you who haven't, you get it from the perspective of a VC and growth hacker, when you know that the only thing that I'm focused on is how do you grow faster to be able to break through as an early stage founder. Now, in addition to that, today, we're also going to focus on the other end as well. And we're going to try and see, after you break through, how the heck do you make money from your founder? And actually, as I was having a look at the session that we were going to do today, it's almost like when you buy, a red Toyota. Every car you see on the street is a red Toyota. It's a little bit like this, as I realized we were going to talk today about how do you exit and actually get liquidity. I started to literally, everything I saw was about the lack of exit and liquidity. So you look at Crunchbase or you look at PitchBook, they're going to talk about the fact that there have been hardly any IPOs. If you look at the craziness that's happening in the world today, from everything that's happening here in the US to the rest of the world, you will see that most limited partners, most people putting money into funds and putting money into stocks and equities, including Warren Buffett and across the board, are sitting on the sidelines. People are nervous. And so this money cycle kind of goes through this big 360 that just goes over and over and over again. And if you are an early stage founder and you're looking at this today and you're trying to get something from it, the biggest thing that you could take is that even though in your heart you are building something really beautiful that the world needs to see, and you have this creativity that means that every single minute on every single day, all you are working on is to get this beautiful product to a market of people who desperately need this product. All of that stuff remains to be true. However, if you don't have a place to exit, then all of the people that are putting money into you at the beginning, why are they doing it? Because they didn't start this journey for you to be able to provide this incredible creativity in the world. They started this journey so they could get out the other side, and they could get out with a better return than they could within the other things that they were potentially looking at. And here's the bad news, or the good news, however you look at it. It's not just your investors. It's also your co-founders, your team members, your advisors, your husbands and wives and kids and parents. All of these people have got a vested interest in making sure that you do not remain poor. The objective is to get you to a place of strength. And that place of strength, in all cases, is money-based. The moment that you have enough money, you can do amazing things. As you see companies and they go like this, and then suddenly, oof, it goes through the roof, whether it's a Snowflake or whether it's a Peloton or whether it's anything else. Never mind what happens afterwards, but they just go oof like this. It's because they have these huge infusions of cash. And those huge infusions of cash are coming because liquidity has been built into the enterprise. So you get it? It's all about this game we play. I mean, I disagree in many ways with the Y Combinator model of just raise, and then work it out. But there's also an aspect of raising money that's really important. The only thing that I layer in with Expert Dojo is that while you're raising and you're making sure that you have the fuel so that other people don't pass you out, at the same time, you're building beautiful product. But you got to make sure that you have it in. So today, let me go in here and let me bring out Chandrashekar right now. There we go. Okay, so you're all privileged. You're going to get a masterclass on how to M&A. How to M&A, how to exit, how to go public, how to not be poor. Okay? That's what we're going to talk about today. So welcome on the stream, first of all.
Thank you, Brian. Thank you. It's my privilege.
Yeah, and you come with a very colorful and rich background in the world of M&A. I know you've had a number of companies. I know you like investing in early stage companies, and I know that you obviously, I'm not sure if you got so deep into M&A because you wanted your companies to actually make some money rather than just give you amazing updates, or because that was a vocation. But maybe share a little bit about yourself, and then we're going to go into the world of how do startups begin with the intention of making other people money rather than beginning with the intention of just providing great product as a venture backable founder. If you're not a venture backable founder, you can do whatever the hell you want. But as a venture backable founder, how do you do that? But a little bit about yourself, please, first.
Thank you, Brian. First of all, thank you for having me here. Absolute fan of you, fan of Export Dojo in terms of what you guys are doing. So it's a privilege for me to be here. Let me go back to my background. So that goes back to 3 decades, close to 3 decades. So
I feel you.
So I finished my Indian CPA. And then once I did that, I joined ExxonMobil, the world of oil and gas, was there for 4 years. But as, the existential grace, happened, I was into M&A. So the first acquisition happened was in my very, very first beginning of my career. And we were basically in the downstream business within the oil and gas. And the entire experience of going through that M&A was so exciting. Then I moved to KPMG, again into transactions. So again, the world of M&A caught me. And then finally, I moved with the organization.
I'm sorry, just before we go past Exxon, when you look at large companies, my whole life has really been in small, early stage companies. So I see it from the developing of the flower rather than the purchase of the bouquet of roses. But when you were looking at M&A in that world, is it just a spreadsheet? Is it just as simple as that? And is the spreadsheet more tied? Yeah, just talk me through the process, the thought process from an acquirer like that when looking at new companies.
So from my experience, Brian, I would say it was very, very disciplined and process driven. And I'll tell you the reason why. I mean, Exxon is highly process driven. They have a book, which they call as a red book. And the whole idea of that red book is to follow, steps one by one. And therefore, the very first step in M&A, even if I was a junior staff, was to go and visit the site, meet the people and understand whether there could be a cultural fit. It begins with something called the cultural fit. And then once that happens, obviously you engage, the advisors to ensure that you do the financial due diligence, the legal due diligence, the technical due diligence, and to a certain extent, the commercial viability, also the commercial DD. So you are now part of, the whole humbug of, trying to see, what is coming out of the entire due diligence and then ensuring, that if things are critical, do we make a decision to still go past because we can make the investment and, ensure that, it is corrected, or do we just walk away? The third important piece is to ensure that the agreements are drafted in such a way that there are certain conditions that need to happen before you sort of buy the business. And therefore, the conditions precedent, the conditions subsequent, that is done in such a way that there is crystal clear understanding of the timelines within what, it needs to be done. Because if the timelines are not followed, there is a provision by which, there could be some bitterness that can happen between the two parties. So that is, again, a very, very process-driven, I wouldn't use the word rigid, a very, very process-driven. But the fun part comes in terms of how you structure the transaction. So I think the structuring is all about how do you pay the consideration? Do you pay everything at once? Or do you have a deferred consideration? Do you have an earn-out or performance consideration mechanism? And how do you ensure that it is also linked to milestones? So to me, first is the visit. Second is coming out with a detailed note in terms of what level of due diligence is required. The third is in terms of even understanding what sort of conditions, precedent conditions, subsequent needs to go into the agreement. And the final piece is the structuring itself. So if you ask me, I think this is what I've seen throughout my career in terms of how you run through the process. Maybe there is a slight, flexibility in terms of how you do it for a smaller organization. But trust me, the process just does the magic.
Yeah. And it's interesting when you talk about cultural fit, because I've been through this now a number of times. And at the beginning, and we've seen what happened with WhatsApp and we've seen what happened with Instagram. And so a lot of founders will feel that the cultural fit is like to see how well they fit in. And it's, see how well the organization fits in with the founder. And the organization doesn't care about that. What they just want to see is like potential damage areas for bringing the in, because like the WhatsApp guys hated the Meta guys when they first came in, but they still brought them in because they knew that they could break them like a fine stallion that they broke down to a poor baby pony. They did it. So they don't care about you being happy, founder. They just care about you being profitable. Right? And is it an imperfect science to go through that process? And should the founders care too much about it? Because I know founders are like, well, I need to make sure we're okay. One of the few companies that I've seen really navigate this well, where actually the cultural fit favored them, was Waze.
Right.
I thought Waze did an amazing job. They're like, listen, we're staying in Israel. We're not going anywhere. We're keeping our team. They're not going anywhere.
True.
We're making sure that we retain our brand and you don't just kill us and put us on a shelf. They did a great job, but that's also got to do with their strength. So is this whole game just about building as much strength as you possibly can as a startup or as a founder, so that when you get to this conversation, you don't get just steamrolled?
Brian, it's a very, very beautiful question. I'll tell you why. I think whenever we speak about M&A, the only reason why we do M&A is synergy. And one of the synergy is the people synergy that you look at. But you asked a question, is there a science to it? I'll be honest, in the number of transactions that I've had the privilege to be part of, there's a lot of art than the science, because end of it, we are speaking about people. So one of the biggest worry I always have is, in the world of M&A, there's a lot of hubris, what I call as ego. And unfortunately, it's so easy to put things in paper to say that this is what we are going to do. But when the actual transition happens, it doesn't happen in terms of the way it needs to happen, because probably there are a lot of ifs and buts and egos, that sort of, crop in. What I've realized, is as we are entering into the shareholders agreement, the one other agreement that we want to insist is, can we have clear understanding of the roles and responsibility in terms of what the team that is coming in, that we want to integrate, is also, responsible for. And end of the day, trust me, it is the manager, who is going to do the magic. Because we all work for managers. We say we work for a corporate, but end of the day, we work for managers. So I always say that, who is manager on the job? Is the manager given the right level of, let me use the word education, to even say that if there's an M&A process, how do you ensure, that, you are able to first focus on the cultural fit. Second, you empathize, because they're now part of a new family, and therefore you got to empathize. And the third, whatever process or learnings that you have, which is, something, that is, you've done for ages and ages, how do you ensure that, that is being passed on in a way that the other person can understand? That's why whenever somebody tells me, here is an SOP, take it, I hate that word, because SOPs are just document. Can we practically, ensure that, that SOP could be understood, so that the person on the other side is able to sort of embrace it and do it, the way that we want it. So I think I always say that people work for managers, and therefore it's very important that, it's the teamwork belief, that needs to be inculcated more. That's why I say it's more of an art. It's very, person-driven, people-driven.
Very powerful. So we covered the cultural piece. And so every founder just knows, look, if you're early, they're going to do whatever they want to do with you. If you're later and you're stronger, you're going to be able to create a lot of terms that you're going to have around that. And we're going to go later on. We're going to go into like the mistakes that founders make on these types of things, and we'll jump through it. What was the difference between KPMG as a process with Exxon?
So ExxonMobil is much, much, much larger. And therefore, you had certain ways which were sort of, monitored by, you had your internal audit teams, which was also monitoring that. So it's a beautiful process. KPMG is much more flamboyant, if I have to use the word. And therefore, you had that flexibility, and the sort of independence, to go about and then discussing, with, partners in terms of what you feel about a transaction, both the ups and downs on both the buy side and the sell side. And I think that gave you a much better learning, if I have to be honest, because you're not one-sided. You're trying to look at both sides, and probably you're trying to come to this beautiful strategy of win-win. So something I learned very early, thanks to my KPMG days, is to see a transaction to be a win-win rather than making it one-sided. That's why, I say the last bit of structuring comes in very, very handy, because most transactions fail because of poor structuring. And probably, as I was dealing, on the due diligence side, on the structuring side, as part of KPMG, it helped me a lot to deal with a lot of law firms. And though law firms can be a bit slow, they can actually, appear to be lethargic, but trust me, they have got the best mechanism of how to ensure, that things could be balanced out. So I think that was a sincere, and a greater benefit I had.
Very powerful. And so what about on the pricing side of it? So we've covered culture, we've covered structure a little bit. And by the way, if anybody has any questions, please feel free to put them in. This is incredibly important because it's not just about, many of you may be feeling, well, actually, M&A, I'm a seed or I'm a pre-seed company. I don't need to worry about M&A at this stage. You need to worry about M&A from the very first second that you start, because that's all your investor cares about. All they care about is you going public or M&A, and everything. It's funny. Just to digress for one moment. I always remember when I became very friendly with the folks in Toronto Stock Exchange and started looking at the stock exchange, even as a very early investor. And people would say to me, "Oh, we're going to go public." And I'd be like, "That's great. What are you going to do?" They say, "Oh, we have to audit our books and get that ready." I'm like, "What's that going to cost?" They're like, "Probably about 200, 300 grand a year." I'm like, what, just to audit your books? What, as a company doing, a couple of $1 million a year or 5 million? Wow, that seems a lot, a very high percentage. And they went, "Yeah, but then there's also compliance, and then there's legal, and then we have to manage the investors. That's another, $300,000-400,000 a year." So I'm like, so if you're a company doing $10 to $20 million a year, literally 5 to 20% of your entire revenue is going towards compliance and making sure you're like, I don't get it. And I never got it. And now I'm starting to see, and I get it if a company's doing billions and billions of dollars a year, like that's okay, or hundreds of millions or whatever. But you leave yourself open to so many things. By the way, if you go public, if you don't get sued, there's something wrong with you. It's because your revenue isn't good enough. You should really want to be sued. So anyway, my point in this long story is just that everything is M&A for me. Like, why? I think it's glorious that somebody would want to build a public company, and it feels great to go to the stock exchange and ring the bell. But you just entered a whole new snake pit of really difficult things. Like, if I'm given the choice today of taking my $1 billion and putting it in the bank and calling ourselves a nice family office and having our own crest and traveling in first class rather than hiding at the back of the plane, oh man, I'm just going to take it. And I feel the sentiment of the world is almost moving in that direction now, the better the M&As are. So there was 2 questions in that dialogue. The first is, what's your feeling regarding going public and M&A? And your second is, how do you make sure that you get the best price for your M&A? And then we're going to start moving into the mindset of a founder at the beginning.
Sure. So let me share my thoughts in terms of, about this, whole IPO, going public. I think to go public, there must be a much more compelling reason. Okay, I would begin with that. For example, you want to raise a significant money, and therefore you have chosen the right level of advisor who's going to help you, put the prospectus out, ensure that the messages are clear there, the risk factor is completely sort of shown. But then you are either doing a project or you're doing something that is going to be significant in terms of the capex money also, so that the money that you raise is sensible, is meaningful. Unfortunately, as you rightly said, Brian, in today's world, going to the public, has become, like a child's play. Unfortunately, if I have to use the word, because anybody and everybody wants to go to the public, and that's the only way they think, they can make millions and billions of, dollars. So for me, an IPO or a public is all about understanding the need for what is the reason I'm raising the money, and what is the way, that I should even think in terms of, the other aspects of the public market. As you rightly said, regulations. It's highly regulated. And therefore, if one or two, sort of aspects that go bad or creep in, I think that could, sort of be a death blow, for the entity itself. Or it can put at least, a lot of misery, on the business. And therefore, compliance is something that one needs to plan for. And you're right, it doesn't come cheap. It's quite expensive, to ensure that all this is done. Plus the number of advisors, that you have around you are significant. And therefore, I think it needs to be well thought of, purpose-driven, a compelling reason, even to go for a public. Let's come to M&A and the pricing. I always say that for a win-win strategy, it's very important, that the valuation range is sort of agreed, with the seller and the buyer. And this is the first exercise that we do, Brian, as part of my advisory firm, which is called ANOVA. The one thing I have firmly believed is to have a very, very open conversation to say that from whatever you have seen, this is a sort of pricing. And we all know that sellers want higher price, buyers want lower price. We all know this. So it's a given. So having had this experience of what one expects, how do you balance it is a lot of art, which is where, I think the learning has been phenomenal. And I always, ensure that there are two things we do. One is, look at the comparables, look at the precedents in the market, and then show that as a justification. And then have a very, very basic thumb rule mechanism to say that if the seller was going to buy the business, what sort of multiples would the seller want to pay in terms of what the seller believes about the longevity and the growth of the business. For example, if it is an EBITDA multiple, we are speaking about the number of years by which you can recover that value. And there's a time value of money also. Let's not forget that. There could be external incident which could go in favor or against. There could be internal incidents going in favor or against. So how do you do even the sensitivity of the scenario and then do it? This is something we go deeper, Brian, with the sellers, ensure that we agree on a valuation range. And then, we are testing the waters with the buyer in terms of, what they are looking for. Let's say they look beyond that valuation rate. That's always a win-win. But let's say they're looking below the valuation rate. That's when the issue comes up. In my experience, typically, because we do the precedents and comparables, we are able to manage on the both sides to explain how that optimal valuation, I'll never use the word right, I'll use the word optimal valuation, could be brought about.
There's an interesting question that's just come in, which is like, how are early stage companies valued? Okay, so this is always kind of an amusing way to start the day. I like this because we need to kick off a Monday with a little bit of humor.
Yes.
And so it's all made up, right? We know this, right? So if you're an early stage company, it's like a game. And the game is we're going to pretend that the company is worth something. Now, what we all know is a pre-seed or a seed company, if they go bust, they are worth zero. Even if they don't go bust, even if the founder stops working on the company tomorrow, they're worth zero. The IP is worth generally zero. The things that you've built are worth generally zero. Pretty much all of it's worth zero. So this early stage environment is very much about what is the value. It's very much what you've been saying here. It's like, what is the value that can be added onto the company that's actually going to buy you? It was why it was so genius what Facebook did with Instagram, because Instagram didn't really have revenue as far as I remember. It just had a lot of users which were coming on board, but Facebook had way more users. And the thing is, the users were probably very similar between both. But what Facebook realized was they were going to have different demographics of people in the future. And this thing, based on future value for them, was worth a lot more. Can you maybe speak a little bit more to this? Because there's a very big difference between a company that's like Series D and it's doing $10 million a month in revenue and a company that's maybe just got a lot of users, but it's growing very quickly.
First of all, let me share, M&As at an early stage do happen. And I'll tell you the reason why does it happen. I think founders are always smart. I've always felt, founders are smart. And I think if you give them the right level of messages, they become even more smarter. So one of the reasons why M&As happen is acqui-hire. The founders know, that even if, let's say, their product is not doing well, the people behind the product, including themselves, are worth something. And therefore, M&As happen just to ensure that the people are taken and integrated with the existing business. The second reason, which I firmly believe, is that here is an early stage business where, a bigger entity is not able to sort of experiment what these guys are doing. I always say that elephants don't dance because there's a lot of bureaucracy, which is there in the bigger companies. But then they found something which is very, very sweet in the early stage, what these guys are doing. They believe that it's going to be disruptive and not a mainstay. And therefore, these guys want to ensure that they look at four aspects. One is what is the scalability of this particular, business that they've built in. Second is, very important aspect is where does this sit against the competition? If they believe, that, this sits, nicely, about the competition, I think there is something which is highly meritorious about it. The third aspect is, let's say they're able to carve a niche for themselves in terms of certain marquee customers from whom they're getting revenue. That shows, that there is a trust and believability, that the customers, have had on them, which is again a fantastic thing. And let's say, these guys have, been in a position to show and demonstrate, their metrics in terms of how they want to run the business, which means there's a discipline in the way they're running the business, the way, they want to show what's their burn rate, the way they want to show, when they want to go to the next fundraise. I think all that is very, very attractive piece for a mid to a large buyer. And this is where we see M&A is coming to us. The large guys, or let's say the mid-stage guys tell us that this is the sort of contours that we want to buy, the early stage startups. And that's where the magic happens, provided these four elements, that I discussed are truly there.
Yeah. And that actually brings me to, I think it's such a great question, because it brings me to the next point. So if the objective as a founder, look, there are some founders, you want to build beautiful things and you're not focused on money necessarily, in which case you shouldn't have investors, right? But if you do have investors and you're focused on money, then my personal belief is that if you have a large equity stake in your company, you should be looking to get acquired. Now, there will be founders who will absolutely disagree with me and say, Brian, they should take them all the way. But like, to whose benefit? Right, to whose benefit? Like, as an investor, I would like you to, be a $5 billion company. But can you spend $5 billion? Well, you don't have to worry about it, because by the time you become a $5 billion company, you only have 5 or 10% left in your company. So which is better? Is it better to spend 10, 15 years working for VCs, building out a $5 billion company, having like the guy from Lyft, largest shareholder in Lyft, has got under 1% in the company, under 1%. So even if they're worth $30+ billion, what is that? There's like 3 billion, 300 million, and probably not even 300 million. After you take away like all of the messing around and tax and bits and pieces, then you're down to like 100, 140, 150 million. And like, you might say that's a good exit, but is it really for one of the most successful companies in the world? Got 150 million. So would you have been better off taking an acquisition like 5 years ago, 8 years ago, buying yourself a little beach with that money that you could have got, and you probably would have got 200, 300, $400 million. So I'm suppose my question and encouragement to people is, be very mathematical and self-serving for what you're doing. Don't just buy the Kool-Aid and drink it all day, every day, in the interest of building a unicorn so you can look like the most famous person who ended up with no money at the end of it.
Beautifully said, Brian. Beautifully said. Just to add a couple of cents, to my 2 cents on this, I think from experience, what I've seen is M&A is all about timing. And, sometimes, you got to seize the opportunity when it comes your way. It's like, exits as an investor. One of the best advice I ever got is, whenever you're getting a secondary or an exit, just take it. Don't even think twice, because that's the perfect timing. Of course, you're intelligent enough to do your analysis, but the person said very beautifully, just do everything within your mind to take it. I think what happens, Brian, is, it is a personal, it's a personality, of the founder. It's the sort of internal decision of a founder in terms of how they want to run a business. Because one of the best examples that I keep telling myself is a business called Flipkart in India, which Walmart bought. And when Walmart bought Flipkart, the founders hardly had 7%, but the valuation was north of 17 billion. So you can imagine that a 7% on a 17 billion is more than $1 billion, and that's what they got, which is a significant money. Today, both of them they run their own funds. As you rightly said, you can run a fund, you can have all the fun, that you want. So I think it's all about timing. It's all about, having that mental toughness, even to make a decision that sometimes, you have to let go, to have a much better peaceful life. I always say that genius is a person who knows what to hold on to and when to let go. And I think that's a decision that something, that the founders and the founding team, needs to decide for themselves, because sometimes the delay, could help if they know that the trajectory of growth is in the right direction. If the trajectory is not in the right direction, obviously, that's where all this valuation mess issues, discussion come in. And therefore, to me, it's all about the timing.
Yeah, I always take my dad's advice with this. Just don't be an idiot. We all turn into idiots. By default, we're idiots, right? And we have to like un-idiot ourselves. I mean, I actually had a founder recently. I didn't say anything because I didn't have the heart to say it, but like, they was offered, in the late hundreds, and he's like looking for an extra 50 million. I'm like, dude, you're not going to spend it. Your kids are not going to spend it. Their kids are not going to spend it. Like, I understand why your investment banker would say, go for a little bit more and play the game. But really, your job, to your point, is don't mess it up, right? That doesn't mean crawl and beg and be subservient. But what it does mean is you have to start at the very beginning with the intention of getting acquired or building a company to a large enough stage that you get an exit, a liquidity event in the shortest time possible. That is your job. Your intention should be to make sure that you have worked out your life goals. So, like, for example, I will tell you, I know a lot of people who were very equity rich and then they went very poor. I know one guy who he was in a meeting in 2001 and he was offered $350 million and he's like, you can take your 350 and shove it up your ass. And for those of you not old enough, you will be like, well, I don't know what happened in 2001. It was bad. It was bad about like 2 weeks later. So know what you want. How can people start? Okay, let's actually begin with biggest mistakes, first of all, that startups make in the world of mergers and acquisitions and building it. And then I want to then go directly into how do you create that mindset from the very beginning of maximizing your opportunity, which might be the same answers.
I think the very first aspect I would say is, what is important in the world of M&A for the startups is to understand, the sort of fit with the other person. I always say that M&A can be called as mergers and mergers and acquisitions, but when I get closer to people, I say it as marriages and alliances. It's the meeting of the minds. So I think if you're a startup, wanting to do an M&A, I think the first biggest message to you is an alignment, with the person, who wants to buy you out. Because if the alignment is not there, trust me, as founders, you will definitely want to be there either for a transition period or maybe a longer period. And I think, if the meeting of the minds is not there, I think that's where the M&A could fail also miserably. So the very first thing is, do everything that is within your mind to understand that there is a fitment on alignment. That's the first message, I would want to give. I think the second is ensure, that, you're able to have your, the broader growth story laid out in such a way that it is very, very, realistic to understand and not just a hockey stick. Because one of the concerns, I have with founders is that in the hands of a better, sort of a buyer, the business can scale to a much significant extent. Now, this is like to be honest, a movie, a larger than life story. To me, what is relevant is, do you believe in realistic, sort of business plans to say that if this is the investment, what sort of scale I can get? Because it's not just about the top line in an M&A, it's always about the bottom line. Many founders forget the fact that if you just put the money, you'll get the top line. Therefore, you're going to do extremely well. No, I always say that sales is vanity, profit is sanity, but cash flow is reality. And that's M&A for me. If you don't have the real free cash flows, I think, it doesn't help, the
Say that again.
Sales is vanity, profit is sanity, cash flow is reality.
Lovely.
So it's very important, in the world of M&A, that you have free cash flows. Otherwise, that's what determines the value of the business. So the second is, don't believe in simply a hockey stick growth. Ensure that your business plan is well thought. It is realistic so that the other party on the other side gets the confidence, that this is worth, doing. The third important aspect, which I believe is very, very relevant, is know your rights. I think what happens is, read the documents with a lot more, detail. Ensure that you know what is your shareholder rights as well as the obligations. And, there'll be conditions like tag along, drag along. You got to ensure that you're able to get a better understanding, the reserve matters. Because all this is where, unfortunately, the bitterness can happen if you have not understood, what it was in the first place itself. So I think understanding the documentation is very, very important. Going through it and, being practical about it is very, very important. And fourth, if you want to ask me, I think it has to be a full-hearted exercise. You go full blow, full-hearted to ensure, that you're going to be part married to the other business and ensure that, the synergy is literally, felt by both the parties. So that's how, I would, want to feel it.
So everything you say, I entirely agree with. I just, there's a part, I'll layer on maybe one or two little things, and I would love to get your opinion on them. I think it also depends if you are being bought for stock or if you are being bought for casheroonies. If it's casheroonies, then here's the thing. This is not like, you just moved from being a single parent into a new relationship where they're going to mind your child. This is that you as a single person have just left your partner, or their partner left you, and you're moving in with the brand new partner, and you think you have some kind of say in what your previous partner does and where they're going to go to. You sold, I don't want to say baby because it's tough. I'll say it. You sold your baby, like you sold it. You took money, you profited. You don't have to worry so much about, like, there's some cool questions in here which I like. How do we protect our interest in an acquisition deal? If they buy you for cash, your interests are your wife, your husband, your family, your local liquor store, your local convenience store. Like, they're your interests. Okay, for me, and it doesn't mean that you don't take all of this really great advice about making sure you have the right attorney and making sure you're okay. But like, you give me $300 million, I take my money, I put it in the bank, and I hope for the best. But the objective was the $300 million. Like, the objective was never, if you're going to go down the road of being a venture backable company, the objective should not be your love of what you do over the profitability who enabled you to do what you do. It's very, very important. Now, if you vote for stock, it's a whole different ballgame, because you need to make sure that the company who is buying you and whose stock you are now taking, that there's really good upside. You have to now do as more diligence on them than they do on you. Because if they buy you for $100 million and then their stock price drops by 90%, well, it ain't $100 million anymore. It goes down. And so I think it's you said it at the very beginning. Ego kills deals. And we get carried away with, we want too high a price, we overprice ourselves, we make sure that we're okay. And then afterwards we're like, well, man, I built this up. You should take care of it. Why should they take care of it? You just sold it. Exactly. You took cash.
And Brian, because you said this, there's a beautiful statement, it uses the word detachment, a very powerful word. And the statement is, detachment does not mean that you own nothing. Detachment means that nothing owns you. So you use the word baby, right? So detachment is not that you own nothing. Detachment is that nothing owns you. It was your business. Yeah. Probably, let's use the word baby, but can I be detached? Because it's no more mine. I just need to ensure, that I'm being true to what I'm doing. And therefore, let me take my next life, next part, and keep on moving.
There's a financial transaction, and you should feel amazing about it. Exactly. Look, the idea of life, if we're going to go like super deep here, and it's hard for a startup investor at least to go super deep, but if you're going to go really deep here, the objective of life, just below finding your life purpose and being able to like enrich people around you, just below that is being in a place of power.
Exactly.
Right? Don't be poor. Like, don't do that, because when you're poor, you can't help people. You can't do wonderful things. You can't like enrich yourself. You can't like live your purpose. It's super hard unless you're like a more amazing person than me. Put yourself in a place of power, and that way you can lift other people up before yourself. And so the first objective, I always say to all of our founders, look, I had a founder come to me and they were selling out for like, I don't know, early. It was like under 10 million. And I'm like, you suck. Because you could get 30 or 40, but you wouldn't suck at 30 or 40, because 30 or 40 would give you your entire life without having to worry about money. You can't do drugs, and you can't be going crazy on alcohol, and you definitely can't have a few marriages. But like, leave aside all the silliness. You got yourself your whole life. You never have to work again. Never have to turn up at 8:30 in the morning anywhere. You can do as many startups as you want that you love. Like, what happens to us when we start this company? And suddenly we're like, oh yeah, man, I'm like a CEO of a 400-person company. No, you borrowed $300 million. Like, get that sack off your back and get some money in your bank account and enrich yourself for the future. So I just like, look, Pranav, who I love Pranav, and he always brings up good questions, but like, what are the risks of being acquired by a large corporation as a startup? I don't know, making money, getting rich. Like, that's the biggest risk. It's cool. It's okay. You should do it. And okay, so which takes me to the final piece, which I think is really, this is kind of the anchor for everything. As founders get bigger and bigger and bigger and better, they work this stuff out themselves. right? We all do. We all work this stuff out ourselves. We're like, oh my God, I better stop losing money. Shoot, stop losing money, everybody. And then we're like, oh my God, I better actually hire somebody that's not my cousin or the person who was homeless yesterday and is now part of my startup. And like, but I think the really brilliant people at venture backable success are the people from the very beginning that kind of map out the way to be able to do this. And it's everything from letting people in other organizations know that they exist, putting them on lists, letting them see as they rise, building out their PR. Like there's a lot of stuff you can do to make sure that you put yourself in this place of acquisitionable sooner rather than later, and then getting yourself the best price because they become emotionally involved in you. Can you maybe speak a little bit about that? I know I stopped you at KPMG, but like all of the experiences and everything that you've had, maybe let's just put it all into this conversation.
It's actually a very deep question, Brian, to be honest, because what makes a founder, get to that M&A, capability or, even, being acquired. I think from my experience, Brian, I would say this with absolute certainty. It's the authenticity, number one. The second is vulnerability of the founders, which is what, makes the whole journey much more exciting, for a buyer. So I think if there is a founder who is getting into M&A, I think the way the founder, needs to even share the journey is to explain some of the, the faults that the founder had, but how, they sort of, overcome, the situation, because we are all vulnerable people. None of our lives, goes, just, the upside direction, it's always a zigzag. So I think that's very, very important. But when that is being conveyed, what is important is the authenticity itself. The way, they are true, in terms of how, they want to sort of, mention, their entire journey. The second, if you ask me, is all about the team building. I think if the founders are not able to build a team, that puts significant risk in terms of their business, for growth as well as for acquisition. I always say, a teamwork makes the dream work. So I think it's very important that you build a team which is stronger, which is capable, which has got its own, sort of independence. At the same time, they have the responsibility. I mean, we always feel, that if you let somebody do what they want to do, or trust me, they can surprise us with their ingenuity. That's the whole lot of, giving their independence to people. So I think building the team is a very, very important capability when, we look at M&A opportunity. The third is the information flow, which means what we are mentioning here is, I think, how well you maintain your information. Because end of the day today, data is power, and power comes out of the information that comes out of the data. We always say that if you slice and dice the data, I think you can, get one of the best sort of, basis that you have for even doing M&A. In fact, I say that numbers never lie. So if you torture data long enough, it can confess to anything. So that's the power of, information that a business should have. And I think that's where, let's use this word corporate governance, the discipline, the regiment of ensuring, that you have periodical, P&L, balance sheet, the cash flows, the metrics, that you have in the business. Because I always say that if you can't measure, how can you manage? If you're able to give that confidence, to the other person, that this is how, well, you're managing your business, because you may not have a balanced scorecard, but you have got some amazing, metrics, KPIs, that you believe 3 or 4 that really matter for that business. And I think the fifth point of view is always to ensure, that, you are able to be very focused in terms of how we are growing the business, which means there has to be a plan, there has to be a budget. And, you got to have this confidence, saying that how I'm going to beat the budget. And therefore, how do you even have a stretch budget for yourself to ensure that you're able to go much more beyond what you think? Sometimes, how do I take away the limitations from myself and, sort of, try my best to reach there? I think that's the name of the game, for me, for a business. And if somebody is very true to this, I think becomes an ideal candidate for an M&A.
I love that. And I'll add one extra point in, because I actually, as I asked you the question, I realized to myself, what I'm really asking, if we put this into relationships, is like, how do you begin at the very start of a relationship with the intention of upgrading your relationship to somebody else within a 3 or a 4 year period? Like literally, you're only in that relationship so you can have a better relationship in the future. And that might be tough in relationships, but in startups, it's how you have to think. That is how the great founders, I have a founder, a great friend of mine, Josh, who's had eight exits now, none of them more than 3 years. In and out in 3 years, always in and out in 3 years. He has his timeline. What he does at the very beginning is he calls all of the companies in that sector who he thinks could be potential acquirers, and he asks them what is their requirements and their need in that area and how much would they pay for what. He then builds out an epic insight, which I think is so important to like create against that enemy. And then he communicates towards that need that they will have going forward right from the very beginning. So you are literally starting with the attention from the very beginning. Okay, if I'm going to be acquired, if I'm skincare brands and I'm going to be acquired by L'Oreal, then I know that they acquire companies that are only doing like $3 to $5 million a month in revenue. So I have to get to $3.5 million a month in revenue. I know that they like 2 to 3 lines, and I know that they have a gap here. And you're building a product. You're not building a solution looking for a problem. You're finding out the problem at the beginning and you're speaking to the acquisition. This will serve you so beautifully well all the way through. And I if I just layer in politics for one sec, and then I want to give you the last word. And I'm actually going to layer in 2 things. Number one, I think everybody should have an M&A coach at the very beginning.
I think so.
Right. That coach is it's not like 24 hours a day, but it's at least half an hour a day. Right. So I think that coach is there. And then the second thing I just want to layer in, which I thought when it comes to like M&A relationships, if we look at the relationship between how Canada have reacted to the US, and let's look at how Mexico have reacted to the US, it's very interesting because the level of abuse was exactly the same. Right? President Trump said, we're going to change the Gulf of Mexico to the Gulf of America. And it's like, you do realize you stole all of California from those poor Mexicans in the first place. But anyway, like, so it's highly insulting. And then he said, and we're going to add tariffs to 25%. Highly insulting. Now, he said the same thing to the Canadians. You can be the 51st state. Highly insulting. And then he said, we're going to add 25% tariffs. What do the Canadians do? And by the way, I promise I'm not judging. I love Canadians. But like, what happened was there was this national fervor where everybody's like, we will destroy him. We'll go here. And so what happened was nobody wins because all you did was you just sent an elephant in, a smaller elephant to fight a bigger elephant. Like, it's okay. Your people will feel good. You'll probably get reelected, but you will lose horribly. What did Mexico do? They sent a serpent in to fight a snake.
Exactly.
She said, well, I really like President Trump and I respect him. And I know that the last thing that President Trump would like is for avocados to go from like $2 to like $8. The American people don't deserve that. Neither does the president. And he doesn't want it. What he wants is for us both to be fair, And I'm like, oh, it's beautiful. So, look, there's an art, right?
It's an art. It's an art.
And you got to speak to what they want. So last words to you, please. I mean, obviously, M&A coach. I think everybody should have an M&A coach, period, right at the very beginning. Learn about this. You know nothing about building a billion-dollar company. You need to learn about what it's like right from the very start. And then as far as just last comments and words, and how can anybody contact you as well?
I mean, people can reach me on LinkedIn. I'm very much available. I'm quite fast in terms of responding also. But because, Brian, you spoke about the last words, I think I'm so motivated from you to share this. I think in the world of M&A, it's all about commitments. And, whenever two parties are discussing, I always say that be very, very cautious about what you're committing, because when you make a commitment, you build trust. And when you keep it, the trust grows. It's all about, doubling the trust. Because if you double the trust, what happens is the valuation and the other things, trust me, it just falls your way. And I think it's very, very important that be very, very careful and cautious about what you're committing to, because this is where I used in the beginning that sometimes unknowingly the ego creeps in and we start sort of, promising things could be beyond our reach also. So I think be very, very cautious about commitment, because that's very important. Probably this is where, Brian, if I have to borrow your word, a coach comes in and sort of helps you balance in terms of how you articulate things. How do you sort of understand that there are certain timelines, there are certain benchmarks, there are certain milestones by which you achieve it. The second thing I would always want to say is that M&A is a process, and therefore, it is going to take time. There are going to be a lot of nays that one is going to hear, but that doesn't mean that's going to stop the transaction, because as I said, this is where the agreements come in: conditions precedent, conditions subsequent. So you just got to follow. And therefore, the only piece of wisdom that I want to give is start slow, start small, build gradually, but build strong the entire process. Because if you don't build strong ultimately, then you're not actually being purposeful. And Brian, you said beautifully that money is something that's very important. You're right. Money is what money can do. What money does, only money can do. So I think it's very important that if you're doing an M&A, trust me, there's going to be a lot of wealth that's also going to come your way. This is what I tell the founders. M&A is one way by which you're going to become ultra rich, and therefore you can have your life the way you want it. And therefore, let's be highly process driven, because where there is process excellence, there will be excellence in results. You want the best results, you need to have the process excellence. And if you're very, very disciplined to this, trust me, the whole thing, can get easy on you and not hard on you.
Oh, it's beautiful. Chandrashekar, you are a gentleman. I love it. Great advice. Thank you so much. As always, anybody can contact myself, Brian at expertdojo.com. Chandrashekar, you've got him on the title as well, so people can just reach out and grab him on LinkedIn as well. And otherwise, just go out there and build a company that folks are going to want to acquire. You have all the advice in the world today.
Exactly.
Okay. Thank you, my friend.
Thank you, Brian. What a privilege, for me. Thank you to everybody who has been here. Absolutely loved, the way you articulated the whole thing, Brian. Lot of things to learn from